Hi, today we're going to do a lesson on non-current assets. So let's start off with the theory and then I'm going to do an exam question with you. So looking at the screen we have, let's look at the definition of a non-current asset. So the cost of a non-current asset, it's similar to stock. It's all costs incurred to bring the asset into a condition and location ready for use over its useful life. So that's important. If you purchase it on cash, then it's just linked to bank. But if you purchase on credit, then you owe the money to a sundry creditor. So that's different from a normal creditor, because a normal creditor, which is a creditor's control, is for purchases of stock. So if you buy a non-current asset, it's owing to a sundry creditor, which is a new account. Okay, now we've done depreciation in the past. And the definition is the allocation of the cost of a non-current asset over its useful life. And so far we've only done the straight line method. Today we're going to learn about the reducing balance method. So basically, if you have an asset, you want to work out how much you use every year, and you multiply or you calculate how much you use of the asset based on how much it cost you to buy originally. So it's not just the invoice price. So if you look here, all costs incurred, so that would include how much you bought it for originally, but then also things that you pay, such as modifications, installation, or anything else that you add to it. Remember, if it's per year, so insurance or rego and things like that, that you pay only for a year, doesn't get added to the non-current asset because it doesn't provide a benefit over its useful life. Okay, so looking at the main difference of straight line method and reducing balance, straight line method is suitable for assets with no moving parts. So what does that mean? I'm talking about things that don't move, like shelves or a couch, something like that, chairs. Whereas reducing balance is more suitable of things with moving parts. So anything that's machinery, so a printer, a computer, a photocopier, something like that, a car. Okay. The way that the straight line method is used, which we've done in the past, is that it allocates the same amount of depreciation every year. This matches its revenue earning pattern, assuming that it provides the same amount of benefit every year. That means that if I buy a shelf, I'll expect to use it the same amount every single year. So if I bought a shelf for, I don't know, $500, I plan to use it for 5 years. So that means that every year I'm going to use $100 of it. I'm going to use it, it's just going to sit there and I'm going to put books in it. Whereas reducing balance is a little different. It allocates more depreciation at the start of the asset's useful life than the end. This also matches its revenue earning pattern, assuming that it provides greater benefit at the beginning of its useful life than the end. So if I buy a car, I would expect to use more of it at the start, or it's more useful at the start, and over the years, it becomes less useful because the parts are worn. So I would depreciate more at the start and less at the end. So that's a key difference. In terms of calculation, the straight line method, we've learned that it's historical cost equals, no, hang on, depreciation equals historical cost minus residual value over useful life. That's what we learned at the start of the year. Alternatively, you can also calculate using straight line method, just using a percentage. So say it could just be 20% per annum. Let's do an example. So we've got, let's say I bought a car. So purchased a car for $10,000, depreciated at 10% a year. So if you think about it, which way should we use? Does the car have moving parts? Yes. So we should use reducing balance, but it's up to the accountant whether you want to use straight line or reducing balance in terms of the course, as long as you justify it. If it asks you to do straight line, you should do straight line if it specifically tells you. But if you were to make a decision, I think reducing balance would be better for a car. So if you bought a car for $10,000, depreciating 10% a year, then basically if you do like, if you map out every year, you can see that in the first year you're going to depreciate $1,000, and with straight line method, this is straight line method, you actually keep using the same formula. You keep multiplying it by the original cost, and every year you're going to depreciate $1,000. So then at the end of 10 years, you're going to depreciate, like you're going to use the whole thing, $10,000. As opposed to if you use reducing balance, a little different. Reducing balance, you would actually depreciate more, and it's not more at the start and less at the end, and it's not usually the same percentage, it's a different percentage. So if it's reducing balance, you use, let's say, 20% here. So that's straight line, and then 20% using reducing balance. So we'll just do this, making it up as we go. So the first year you'll depreciate $2,000. Then the following year you don't times it by 10,000 anymore, you times it by the carrying value. So the carrying value is 10,000 original cost minus the 2,000 that you depreciated the previous year, which gives you 8,000. Then you times it by the 20%. So 8,000 times 20% is 1,600. And then you keep going like that. So in the third year, you'll be 8,000 minus the 1,600 you depreciated the previous year, which gives you 6,400 times by 20%, which then gives you, oops, $1,280. This one I accidentally got rid of. And you keep going until you reach 0, but there's actually a pattern. The pattern is that I think if you subtract these ones, you'll see a pattern. So it's 2,000 minus 400, 1,600 is 400, and then this one. Excuse me. Okay, if you keep going, what are we up to? 6400 minus 1280. What's that? Times 20%. And then I don't think the pattern's working, but that's how you do it. You keep going with the carrying value and you keep going all the way down, multiplying the percentage with the carrying value. So I've covered the key differences between depreciation, reducing balance, and straight line, and I'm going to end this video. In the next video, I'm going to do an example with you.